Hi everyone, Kyle Johnson here from McMinnville CPA. Last week, Congress passed a major tax bill, the One Big Beautiful Bill Act. Whether you're a small business owner, W-2 employee, both, or even just a taxpayer, legislation could impact how much tax you'll be paying, how much you should plan for 2025 and beyond. Today, I'm going to be covering the most important income tax changes for both your business and your personal income tax returns. Let's start with small businesses. The 20% Qualified Business Income Deduction, QBI, for pass-through entities like LLCs, S corporations, and sole proprietorships is now permanent. That means that 20% deduction that we started to get with the Tax Cuts and Jobs Act in 2018 is now permanent. Additionally, also made permanent through 2029 is 100% bonus depreciation. On the personal tax front, let's talk about a couple of items that were made permanent with the passing of this bill. First things first, we have the tax bracket adjustments. They have been made permanent. So the top rate will remain at 37%. Before the Tax Cuts and Jobs Act, the top bracket was 39.6%. For the past 6 tax years, we've had higher standard deductions. Those have now been made permanent. In addition to the permanent high standard deduction, we will still have no personal exemptions. Now we get into some of the newer personal tax deductions that are out there. For example, there's now a deduction for tips and overtime pay. If you earn under $150,000 per year and you receive tips or overtime pay as an hourly employee, you may deduct up to $25,000 of that income starting this year through the tax year 2028. For example, if you make $52,000 of base pay and $10,000 in overtime, that $10,000 might now be deductible, a potential of $1,500 to $2,200 in tax savings depending on your tax bracket. There's now new credits too, or updated credits. For example, the child tax credit. It used to be $2,000 per child. Now, that's been bumped up to $2,500 per child through tax year 2028. The same income limitations apply. There's a new senior deduction. If you're 65 or older and your income is under $75,000, you now get a new $6,000 tax deduction starting in 2026. It phases out if your income level goes over $110,000. We've got big changes on the SALT-10, state and local taxes. With the passing of the Tax Cuts and Jobs Act back in 2018, they capped the itemized deduction allowed amount of state and local taxes at $10,000. With the passing of the One Big Beautiful Bill Act, this has increased that $10,000 cap up to $40,000. The $40,000 cap will remain in place through 2029. Additionally, it's also important to note, if your adjusted gross income is over $500,000, which will kick you out of this itemized deduction. For Oregon taxpayers, the pass-through entity election, or the PTE, will still be available. So if your income is over $500,000, or you expect to pay more than $40,000 in state and local income taxes, that might still be a viable option to save and reduce taxes. Lastly, on the estate income tax side of things, the federal credit has been made permanent at $15 million. Additionally, it's been indexed for inflation. Unfortunately, if you're an Oregon resident or you have assets in the state of Oregon, the exemption still remains at $1 million for the state of Oregon, not indexed for inflation. As always, we're here to walk you through what applies, what doesn't, and what changes to make now, so that way there's no surprises come April. Thank you for watching.